welcome to class, everybody. Again, we're going to go ahead and go over chapter 1, which is pretty much the introduction of all accounting, right? This is just basic general knowledge that you will see when moving forth from this class, okay? So let's go ahead and get a little introduction. So first off, right, these are the things that we're going to be looking into class in regards to this particular classroom, okay? So we are going to be focusing on financial accounting, and we're going to take it back to the point where is as if you have absolutely no knowledge of accounting whatsoever. So this is considered the 101 basis. It's the fundamentals as of accounting, right? You're going to learn that this is going to be the backbone of all accounting. All right. So what is going to be taught in this class is we're going to be looking at the accounting equation. Okay. We're also going to be looking at the generally accepted accounting principles, also known as GAAP. Right. We talked about that just about a moment ago. All right. And then we're also going to looking into perspective of a merchandising operations, such as we're going to be looking at what happens when we have sales. Right? We're also going to be looking in purchasing inventory, right? And then also we're going to be looking at how we collect our sales, okay? And then we're also going to be creating our financial statements. So when we move forth and get on to chapter 4, we're going to learn about an accounting cycle, which entails 10 steps to complete, which lets you go from step 1, which is to get your source documents all the way down to the point where you close your books at the end of the year. So we're going to be going through every single step, and at the end of this class, we should learn all 10 steps on how to properly close our books, but also to create those financial statements, okay? And then lastly, it's a small section, right? And it's going to be payroll, right? What do you do when you have employees? How do you pay them, okay? And that is going to be tied up to our entire course, okay? But of course, we want to look at what kind of business organizations that exist in accounting. So again, here we're going to be looking at the nature of the business, okay? So the definition of the nature of a business is any type of organization that uses its natural resources to ultimately produce a product or provide a service for its customers, okay? So, of course, if we look at this in a different perspective, right? Businesses are out for one thing and one thing only. Their main purpose to even create a business is to make money. They want to make the big bucks, okay? So they want to try to reduce all their costs, right? To maximize their profits. So again, the main real core purpose of the nature of a business is to ultimately make money at the end of the day and maximize their maximize their savings, maximize their profits. Okay? So again, how as a consumer, we want to make sure that, when we're dealing with these kind of business or entities, right, we also want to maximize our savings, right? We have buying power in our hands to feed these monies to the corporation. So our main goal is to ultimately save our money, right? Okay. And the great thing about us being an individual is we get to see both sides as a customer and also as well as looking at what a business does, okay? So in this case, yes, most businesses are out for maximizing profits. On a consumer level, we want to make sure that we minimize our costs, right? How much are we willing to spend and maximize our savings, okay? Any questions in nature of the business? Pretty straightforward. Okay. No? Okay. So let's go ahead and dive in the different types of business organizations that do exist right now. So there are 5 major types, okay? Sole proprietor, right? And we'll talk about each one and we'll break down each one individually after this slide. So again, the 5 types is going to be a sole proprietor, partnerships, corporation, limited liability company, and then lastly, non-profit organizations. Okay, so again, these are the 5 types that currently exist as of right now. Right? So we'll go ahead and dive into the very first one, which is a sole proprietor. So what a sole proprietor does is it only has one person, all right? And one person only, okay? You can have multiple people to join your sole proprietor, but in this case, the only minimum is that you're going to have is one person. Hold on. Okay. So, with that being said, as a sole proprietor, there is only one owner, right? Sole meaning one, proprietor is ownership, okay? So that is what a sole proprietor is. There's only one person and one person only. And they own all the assets, liabilities, and earnings that the business makes. So in this case, the owner and the business is one. Okay, so if that person for some reason does does bad business, right? That person is solely responsible for everything. Okay, so again, the owner and the business is one. Okay, a little fun fact here is, of course, when you submit your paperwork to the IRS, it's very important that you need to know this because you get special tax privileges, okay? And with this is just FYI, if your business, right, you need to maintain at least or make profit 3 out of the 5 years that you do business, or else your business becomes a hobby. All right, so this is a good key factor, especially if you want to start your own small business and you are the sole proprietor. You need to make sure that your business needs to make money, because at the end of the day, if it doesn't and it becomes a hobby, you're going to get taxed at the highest level as a personal as from personal taxes. Okay, so with the sole proprietor, you can take a tax deductible, but in this case, if it becomes a hobby, they're gonna tax you on that on a personal level higher than a regular business would. Okay, so instead of getting a tax deduction, you're gonna get a tax increase because you own a business and it's not making any money, so therefore you're gonna get taxed for that. Okay, just a little FYI. So let's go ahead and talk about the advantages and disadvantages when it comes to being a sole proprietor. The best advantage is it's going to be the easiest form of business to establish, right? So for example, all you need to do is go down to the either state agency or local agency, whichever one that allows you to sign up for a business license, right? Once you get that business license, okay, of course, I believe it's now like what, $100 right now to get a business license. It takes about 30 days to process. Once you get that once it's processed and you get that license in the mail, boom, you are an established business owner. It is that easy and it's that quick, believe it or not. Okay, all you had to do was fill out a form and pay $100 and boom, you're already a business. So it's the easiest form of business that you can create. All right. And of course, a good advantage of this is that the owner has full control of every decision that the company needs to make to run its business. So they make all the decisions. There's no one that needs to help them make the decisions, because whatever decision that they make, it's, who's there to argue that this decision is bad, right? You're the sole owner of this business, so you get to call all the shots. in this sense, okay? And then number 3 is owner can keep or retain, or reinvest all the profits back into the company. All right. And that's what you should do as a sole proprietor. Recommended wise, if you are a small business, if you do end up making a profit, you generally do not want to spend that money because it's better that you reinvest into your company. And we'll get to take a look at that when we talk about our equity, in a few chapters from now. But in this case, it's true. Think about it. If your company makes a profit and you owe so much money either to your bank because you got a bank business loan, or even if you had to put everything on credit, right? You owe a lot of people to get your business going, okay? Unless you invested the money yourself. But in this kind of case, it's like you don't want to take your profits and pocket it out to yourself and buy yourself something nice with it. Yes, it's your hard-earned money. Yes, you deserve it. But in this kind of sense, you also need to make sure, what liabilities do I have? Who do I owe? Do I need to pay this bank loan immediately? It should be, because they're going to charge you interest. So those kind of factors come into play. But that doesn't mean that you, as a sole owner, you don't have to reinvest in your company. You can choose to take that money and spend it on yourself, right? Again, as an owner, a business owner, you also have to pay yourself for running this business, right? You're pouring your hard work, blood, sweat, and tears into creating this company. So yes, you do deserve to pay yourself within the company, right? But that's just a personal recommendation that you shouldn't do that if you are starting off your business right away, because you have all these, liabilities, all these people that you owe, people that you need to pay, things that you need to pay for. Okay, so you're better off reinvesting into your company, because what's better about reinvesting about your company is maybe you have more money to upgrade your building, right? Maybe get new furniture. So the great thing about reinvesting into your company is you're going to allow your company to grow. And that's what you definitely would want, that, because again, more new things, more renovations, anything that improves your business, people are going to want to come to your store and want to, continue, with your business. Okay, so it's always a good bonus that you have that kind of thing. And then lastly, personal tax deduction. Number 4 is personal tax deduction. So again, I did touch upon this. You can take a personal tax deduction because you are a business owner. So this is a deduction, as in you get to keep some of your money because you own a business. All right, and that's actually a really good advantage, because if your company, right, if it's a really large company, not like large enough to be a corporation, but if your small company is actually, it's a really good profitable company, you can take a huge deduction from your taxes. So you don't have to pay as much taxes as you would if you didn't own a company. Okay? And then lastly, it's easy to dissolve. So again, all it takes is for you to just go to the bank and close your account, and boom, your business is dissolved. Close your doors, whatever it is that easy to dissolve. You can rip up that business license, but again, also make sure you let the IRS know that you are closing your business, because at the end of the day, if they don't know that you've closed your business, they're still going to start filing tax. They're still going to come after you for your taxes. So make sure you file to them first to let them know that you have stopped doing business and you have stopped doing your operations. You properly close your bank account and you call it quits. Pretty easy, straightforward, and it's quick to dissolve as well. Okay? Now we're going to talk about the disadvantages of being a sole proprietor. So, because you own every single asset in the company, that means you are 100% liable for anything that happens to your company. So, if you owe a $50,000 loan and you decide to make really bad decisions to the point where your business is plummeting and you cannot pull yourself out of it, right? Look at that. You still have that $50,000 that you own, and what they're going to do is they're going to repossess all the items in the business, and then they're going to go after your personal assets as well. So in this case, your personal assets and the assets that's in the business are at risk, especially if they're going to go after your if you owe them $50,000 and you just bought yourself a brand new car, you could say goodbye to that because they might repossess that, and now the bank is going to cash it out to reimburse them for that $50,000 you owe. So again, everything that you own is at risk. Okay? And again, that's what I talked about for number 2. All business and personal assets are at risk. Okay? So number 3 is limited use to personal savings and consumer loans. So again, when you are doing your little, you start up your business, right? Most oftentimes, you're only limited to the funds that you either invest in your company, like your own money, or you might get small business loans here and there. Nowadays, it's very, very easy to get a small business loan, but it's not even that much. The maximum, I believe, or the minimum is $30,000, but the maximum could be anywhere depending on what your business plan is, and you submit it to the bank. But it's also in regards to your credit score too. If you can even afford to make this business loan payment, right? So ultimately, you're only limited to those 2 sources of income. You might get lucky and have someone invest in you, but again, if they choose to invest with you, it's not for free. And we all know that. There's always going to be something, the investor would want something out of it. And we'll talk about that in the next section. But in this case, yes, you are only limited to what you originally invest, which is your savings, and to any small commercial business loans that you do get accepted for. All right. And then number 4 is it does not attract high caliber employees. So again, with that being said, so that's where it ties in to number 5 as well. When you're a small business and you're a sole proprietor, right? You may not be able to afford any employee benefits. You cannot promise your employees, I will give you a 401k plan. I will give you an IRA plan. I will give you, I will let you own 20% of the store. No. You would not be able to afford anything in regards to your employees at all. All right, so that makes employees, right, less likely to want to be involved in your business, right? Think of it this way. Would you want to work for a company that provides absolutely nothing for you? Okay, it will depend on the job, of course, right? Whether you love your job enough that you would want to dedicate your time in there. But then again, in the long run, what benefit are you getting by working in that company? Okay, so whether your benefit and your costs weigh one another, right? There are many reasons why a lot of employees don't want to work for a company that provides absolutely no benefits, because in the long run, when you do retire, you got nothing. You got nothing to be able to support you at that point, right? You got no money in Social Security, or you have no retirement plan. So that's why it's not appealing to many employees, because they, they're more likely not going to be willing to put in their full efforts or full time into a job that's not going to benefit them in the long run. And that's why Number 5, employee benefits are not fully deductible to, the business. Okay, so that's where it ties in, right? Because my employees, right, depending on how I treat them and what benefits I provide for them, it won't benefit the business at all because, you're not charging them for this. You can't afford that. So it's having employees is going to be a small deduction to your company. All right. Any questions in regards to sole proprietors?
No, I'm good.
Okay.
No, I'm good.
Okay. All right. So let's go ahead and move into the second one. All right. So the second one is called partnerships, right? All right. Key characteristics of a partnership is one or more, two or more individuals that own the company. Okay. Remember, one is sole proprietor, two or more, right? A partnership can consist more than two. So that's a great thing. So you can have multiple partners, right? But in this case, it has to be two or more people unless, for any instances, something happens, right? Then you become a sole proprietor. So again, two or more people in order to establish a partnership. And there are two different types of partnership, and I'm going to go ahead and talk about both of them. So a general partnership, which is the first type of partnership, is going to entail, right? Every partner is going to have an equal, if you agree on it, an equal portion of duties, all right? And they get to split the profits evenly. Okay? So that means they have some kind of equal portion of the company, right? They're equal duties, equal responsibilities, and they get equal profits. Okay? So the one thing about the general partnership is everybody's going to be working for the company. Not have one person run the whole show and the other person just lays around and does nothing. No, in this case, all partners are going to have some kind of responsibility in that's contributing to the business, right? The other one is called a limited liability partnership. So this is where you're going to have at least one general partner and the other one's going to be silent. So again, we've seen more commonly, often you will see a limited liability partnership, right? LLPs. And usually what the silent partner is, it's going to be the investor. Okay? So that's what a typical LLP would entail. You're going to have one person that runs the show, right? Does all the work for you, while the other partner, their only contribution is their money that's helping you go ahead and proceed with the company. And what they get out of it is they get a percentage of the profits. And usually that's always like that. You're always going to have one person to invest in you, and all they do is they're just reaping the benefits. They do absolutely no work unless you agree to it, right? Maybe the limited liability partner, all they have to do is one task, right? So you could, again, partnerships, like you have to come to an agreement on how you want everything to be divided, right? So that's typically of what a limited liability partnership does. You generally have at least one partner that does the whole show, while you have the other partner as a silent partner. Okay? Yes, and the other partners are limited to the original investment, and they take whatever portion or whatever it is that they want to agree on, right? What portion of their investment do they want to take the profits out of? Okay? So here's some advantages and disadvantages to partnerships, right? I'm going to go ahead and talk about the advantages first. First one is going to be it's also very easy to establish on a partnership. However, the agreement involves time. So let's say Michelle wants to partner up with Robin and establish a partnership. You guys go to the court, the state court, and you guys file for a partnership, and you guys get approved. Now, is that going to be the final step? In this, no, because you guys have to agree. Who's going to be doing this? Who's going to be doing that? How much am I going to get? Are you going to be doing this? So there's the agreement that you guys have to go all on. And that's why it takes a long time, because, if it's a partner that isn't your significant other, you're more likely to have more agreements and disagreements when it comes to running a business together, right? And oftentimes you always see someone in a partnership had enough and they walk away and leave. So that's why it takes a long time, because you guys have to fill out a paperwork, right? You guys have to create and make sure that you guys are aware of what boundaries you guys have as far as duties, as far as profit shares, and also what you guys deem as equal responsibilities and things like that. So it does take time to be able to do that. But the great thing about having a partner is you're able to actually raise funds, meaning one partner could be a sales representative and the other partner can go out and seek other companies and build partnerships with them. So at least you have the flexibility to utilize the people that you have in your company, right? You have one person that could be running up some other profit center while the other one runs the second profit center, right? Maybe you have one person doing one store location and the other takes care of the other location, right? But you guys are still a partnership. So that's what's great about that. You guys have the ability to raise a lot more money than a small individual, right? You have more, versatility, right? You have someone that can be able to get the profits on both ends, okay? And then number 3 is going to be a tax deduction for profits. So yes, with partnerships, you get a tax deduction for having profits. So that's pretty straightforward, okay? So lastly, number 4, hiring employees that may become a potential partner. So again, for example, right, it's a family-owned business, right? But let's say the owner is husband and wife, right? And so with that, they don't have any children. It's because they don't have lineage, right? They cannot pass down their legacy on to their children because they just don't have any. So why it's really good is because if an employee potentially shows them loyalty, as well as show them their dedication and having them you're trying to mentor them to try to maybe one day take over the business, then that's why it's a high benefit for employees, because they could potentially become part of the company, right? For another example is, what if these two people, right, they're just regular people, or friends, let's say, right? And one of them decides to want to leave the company, then the person who's been working their butts off for the company could be a potential person to be co-owner of the company. So, and because that's one of the biggest benefits when becoming part owner of a business is, just being that in general. So it would more likely to entice individuals to want to work for the company if that was a possibility. Okay. But disadvantages to partnerships is, again, they're responsible for each other's actions, okay, and also decisions, right? Meaning, if a partner makes a bad decision, that means the other partner has to take the fall too, because you guys are supposed to be a collective. you guys are both supposed to be on the same page. So if one partner decides to do something and you agree to it, then there it goes back to you, and it turns out to be a really bad decision, whether it's investing in something or upgrading something, and it just doesn't work in your favor. Then you just have to assume that you're both responsible for that decision. Okay, so that's also a disadvantage, is because, again, you guys are both at fault for the bad decision. Now, a little fun fact here. If for some reason one of your partner is in a meeting, okay, and they need to make an executive decision, if that partner makes that executive decision on behalf of the other partner, right, because you need two of them to agree on one thing. If the partner that is not in the meeting has no idea what the decision is being taken place, right? That partner can revoke their decision. Okay? Little fun fact here, okay? But let's say that person that's in the meeting decides to decide and make the executive decision on your behalf, and you know that they're making this decision, then that is going to be legal binding. Meaning you both knew what the agreement was, and you both agreed, and you both were aware of it. So that executive decision holds true. Pretty cool, huh? So if your partner decides to be shady to you, and they're making executive decisions without you knowing, you can go ahead and revoke that decision, because I forgot what the word is called, but it is where a partner does things behind the one partner's back without them acknowledging it, and therefore the decision can be revoked. Okay. Okay, and then with that, another thing is, it's a disadvantage because profits are shared. Okay? Of course, if you're in the business of making money, everyone wants to claim all the profits. But in this case, depending on how many partners you have, whether it's 2, 3, or even 4, you have to split those profits. And again, not everybody is very happy about that, because they want to take all the money for themselves. But in this case, depending on how many partners you do have, right? Again, if you have 2, 3, or 4, right? Then as you go more in partners, less profits you guys are going to be making. And unfortunately, you have to share your profits. Number 3 is going to be disagreements. So, yes, you will be having disagreements. Okay? No partnership will be harmonious and will make the same decisions, okay? You will come to a disagreement. And for those, people who come to really bad conclusions where the disagreement is larger and it can never be resolved, then I'm going to go ahead and skip to number 5. Then that partner can choose to leave the company at any given time without any explanation. They can either, they can just walk away, and then therefore your partnership is dissolved immediately, right? You need to have 2 or more people in order for your company to maintain its status as partnership, okay? And you need to have that and hold true. So if a partner walks away, that's it. You're done for the business unless you find someone to replace them within a timely manner. Okay. And again, for number 4, some employee benefits are non-deductible to the business. So again, because you guys are so small, some having employees may not benefit you in the long run. It may not be a good tax deduction, depending on what your business is and how your benefits are for the employees. Okay? Any questions in regards to partnerships?
Nope.
Okay. All right. next portion here is going to be corporations. So this is the one that everybody knows. Everybody should know this one for sure because corporations exist all over the United States, right? There are 4 characteristics to what a corporation is, okay? And number 1 is you're going to have shareholders are limited liabilities, okay? Meaning that when you have shareholders, right, they could potentially own a part of the company, right, through shares, through stocks, right? But what they are is they're only limited to the investment that they place or that they purchase the stock for. Their personal assets don't even matter. So no matter whether the corporation has a lawsuit or anything like that, your money does not, the personal assets are not affected when it comes to corporate decisions or corporate lawsuits, anything like that, okay? However, if the corporation, for some reason, goes down really badly, and then you can already expect that your money that you've invested into the company is also going to decrease as well. So that is one thing, okay? Another thing is there's a central management, okay? For example, most corporations, if not all, they have some form of a board of directors, okay? And the shareholders are the ones who elect these people to help run their business. Just like a government, right? We all elect a president to run the country for us. That is the same thing here. Every decision that is made is going to be based on the shareholders, the final decision, but it's also contributed by the board of directors, right? What do the board of directors kind of look at what the shareholders need and what benefits the company by, whatever they need to in order to run the business. If they need to make renovations, they need to open another location, right? All of the decisions are made by the board of directors, okay? And whoever gets the final say will be the shareholders, okay? So that's why they have to have a shareholders meeting every so often, especially because, again, as a corporation, it's the people who make the decisions, not the board of directors. You only elect the board of directors to help run the business. Okay? So with that being said, third thing that's a good characteristics is transferability of shares, meaning how do you get your profits? Pretty straightforward. Every corporation has stocks, and what do stocks do? It shows you that you own a portion of the company, and how they distribute their profits is through dividends. So that's how transferability of shares is going to work when you become part owner of a corporation, right? And then again, continuality of the life will always remain beyond its life, because the great thing about shareholders is many corporations nowadays, they have millions of shareholders, right? They have millions, right? If for some reason your corporation gets really low and everyone's just selling their stocks because no one wants to contribute or be part of this company, what happens is the business will continue its life as long as there is one shareholder left. So that person could own the whole entire company, right? And they will still last as long as there's that one shareholder left. Okay? So again, shareholders are people who own the company, right? They own a portion of the company. And again, how the company makes money is through by releasing those the stocks. So more ownership means more money to other people. All right? Another fun fact here is a corporation or a business entity. How they get established is wherever state that they decide to establish corporation, right? Or we call it incorporated, right, is going to be where their headquarters is located at. So, for example, my fiance's company, right? He doesn't own it, but he's a member of it or an employee of it. His company was incorporated and established in Atlanta, Georgia. So that means their headquarters is in Atlanta, Georgia. And they have little small branches or divisions to help cover the entire U.S. So they have a division in New York. They also have a division in Las Vegas. And they have one in Washington, the state of Washington, Seattle. Okay, to cover all the locations in the United States. But their main headquarters is in Atlanta, Georgia. Okay, and that's just a little fun fact there, that most incorporated corporations, they would have their headquarters in the state that they were incorporated in. Okay. So what are the advantages of corporations? Here, shareholders have limited liability. So that's the best part is, again, you become part owner of the company. All your personal assets are not at risk. They're not going to be touched or anything like that. You're only responsible for whatever amount that you invest in. Okay? So it's a good advantage. That way you don't ever have to, protect your car, because it's not going to ever be, it will never be repossessed by the bank at any given time, right? Shareholders are only held accountable for the investment that they own. So again, that is going to be part 2, right? Your personal assets are not affected, right? They're only responsible for what they originally invested. Now again, 3, to raise additional funds is pretty easy for them, right? All they need to do is to either release more sales of stock. What they also do too is funding wise, obviously, right, depending on what corporation they are, if they are in a corporation where their business is retail, of course that's their main funding. But most corporations, right, the easiest way to raise the money is to just sell more stock. Or they do what's called a stock split. Okay? So it allows you to be able to purchase for a low price and own more stock. So that entices people to want to own more. Number 4 is tax deductions for having employees. So yes, you get to go ahead and be able to take advantage of those tax deductions when you have employees. Okay, so it's very, very, very great that you get to have that. All right, and then number 5 is going to be elect the taxes to be as an S corporation. Now, I'm going to let you guys know this. There's a difference between a C corp and an S corp, and it's not like they're separate entities. The only difference that's really truly behind it is how you're taxed. That's all it is. It's you can claim S corporate status or C corp status, but again, that doesn't mean these are 2 different types of corporations. It's just determined by how you are taxed. All right, and let's go ahead and look at this yellow box over here. So how a C corporation is taxed is you're going to get taxed twice. You're going to get taxed at the personal income level, and then you're also going to get taxed at the corporate tax level. So again, when your profits are distributed, right, and you pull that money out, automatically you get taxed as a personal tax. Okay? And then on top of that, the corporation itself has to also pay part of their tax as well. So they get taxed twice. Where a S corporation, you only get taxed one, and that's only at the personal income level. So most startup corporations, once you elect as being taxed just once. Of course, with that being said, right, if you get taxed only once, that means at the end of the year, you may be subject to have to pay more taxes versus less taxes. Okay? When you get taxed twice, you have a small percentage of getting a refund back. Okay? So that's just truly the real difference in regards to an S Corp and a C Corp, right? Just the amount of tax that you have to pay. Now, disadvantages to corporations is going to be it requires a lot of time and money to be established as a corporation. All right, so I'll give you an example. Target. How many years did it take Target to finally claim corporate status? Okay, so with that notion, a lot of people who go into business think they can be in corporate right away. No. You cannot be in corporate right away. What you do need to do is you need to establish some sort of foundation, right? You need to claim one of the three business organizations first before you can actually file for an incorporate status. Okay? So you need to establish your business first before you can move on into corporate status. Because it's true, right? If you're a small business that no one's ever heard of, do you think anybody's going to be willing to just dump their money into you and expect that you as a company is going to grow? And also, if you're not doing dividends, or again, if you're a small business that no one knows, how can you trust your money to be placed in there to provide the money that you could get back for your investment? Right? Not really. You need to establish recognition, right? You need to establish your brand. You need to do branding. You need to brand name yourself and establish that you are worth the investment. So it does take time, many years into the making in order to finally become a well-known company enough for you to claim as corporate status, right? Other things too is, of course, we'll talk about this towards the end of this chapter, but you guys are monitored by the federal government at all times because, again, corporations are being, they're the ones that are most likely to be more corrupt than a small business, right? Because they get so much money, they get trillions of dollars a day. And think about it. You're investing into this kind of $1 trillion company, but what are they really doing with that $1 trillion? Are they really making the investments that they tell you? We don't know, right? So again, the reason why we have this monitoring by the federal government is because of Enron. If you guys know or heard of Enron, they're the reason why now the federal governments need to take apart control of the corporations because of fraud. Okay? So so basically everything that's going on with the business, especially with your profits and taxation, especially the IRS, they're going to be boggling down on you for monitoring your type of business or organizations, especially your activities, right? Okay. And then lastly, third, if you are considered a C corporation, you have the possibility of paying higher taxes at the corporate level. Okay. Any questions in regards to corporations?
Nope.
Okay. Okay, let me see what time it is. So we have 2 more things to cover, and we'll take a quick break after this, okay? So here is called the limited liability company. So a lot of companies are LLCs, and they're usually corporations who don't want to be in the big game. They want to be they want to be well recognized, but the main concept of a corporation is it's pretty much a hybrid between a partnership and a corporation, right? So they're just a mix between them. And the great thing about a limited liability company is that, of course, just in its title already, limited liability, meaning whatever partners that go into business, their assets are also, their personal assets are also not at risk. They're only limited to their original investment and what they contribute to this company. So again, with that being said, it's not a corporation, and it's also not a it is also not a partnership. It is still an established legal entity, though. Just know that, and it's a mix between a corporation and a partnership. So, what do you mean by that? So the rules is it has to at least have two characteristics of a corporation in order to establish as a limited liability company. So again, let's go ahead and review back to what those four characteristics are. So out of these four, they either need to have some kind of stock options, right? They need to be able to either, have a central government, or they need to have some kind of transferability of funds, right? Or shares, right? So either they have shares and they have a central government, right? And that's pretty much it, right? They need to have at least two of these characteristics in order to become a limited liability company. Okay. So advantages and disadvantages. So the first advantage is going to be taxation, right? They can be taxed at the corporate level, meaning they have flexibility to choose either S corporate or C corporate status. And of course, as a limited liability company, you're more likely to choose the S corporation. Okay, so they can choose, they have that flexibility where they can choose to be taxed at the corporate level. Second thing is going to be limited liability, of course, just like what the title is in its name, right? So whoever invests in this company is you're only at risk for whatever your investment is, and whether it's through the stocks that you own or it is through your actual investment, your own real money into the company. Okay. And then again, you could elect one member to be the entity, meaning, again, because it's a cross between a partnership, right? And in when we learn about partnerships, right, you can have one general partnership, right, for the limited liability partnership, right? This also plays into key factors, saying you can elect one person to be the company, right? There is no annual shareholders meeting. Okay, so again, most decisions, right? Since it's a smaller company, you're not dealing with millions of shares or millions of owners in this kind of sense, because it's a corporation, but a lot smaller scale. So there's no need to have a shareholders meeting, which is a good advantage because then you should be aware of all the decisions that are made, right? Less administrative work, okay, to record the transaction. So again, less work because the limited liability company, right? Less work, you got other people to do the work for you. So this one, yes, it's a lot of limited things in regards to people who contribute to it. There's no shareholders meeting again. The only thing that you would notice is someone is going to be the entity, but also there's going to be a shared, whether you choose it or not, a central government, right? That's because it's one of the four characteristics that makes a corporation a corporation. All right, and then you can also do membership interests can be assigned, okay? Again, I'm not going to spend too much time on explaining this. It's in your readings. So I'm going to go ahead and talk about this, the disadvantages of being a limited liability company. So you need to have at least 2 owners, okay, in order to be a limited liability company, right? Same thing, rules apply to partnerships, right? You need to have 2 or more. You cannot have one person be the sole owner, or else you would just become a sole proprietor. So that's one thing that you need to have, is you need to have at least 2 people. Other disadvantages is you can have a limited lifespan. Reason is because, again, same disadvantages as it is for a partnership. If a partner decides to leave, right, and there's only 2 of you, what are you going to do? You need to find another partner, or you need to just dissolve your company or change your status to a sole proprietor. All right, and then may have self-employment tax. Now, I'm not going to teach you anything about taxes, so this one I'm not 100% too sure about self-employment taxes in regards to why that's a disadvantage. But yes, it's a disadvantage, but I cannot tell you the details on that because I'm not in taxation. All right, all profits exceed 50% will be taxed, all right, by the federal. So again, when you distribute your taxes, or when you distribute your profits, right, if you make more than 50% of your profits, right, you will be taxed. That's a pretty straightforward claim, right? If you make too much money, you're gonna get taxed. Number 5 says cannot take advantage of stock options. So again, if you are part owner of the corporate or of this limited liability company. Now, what a stock option is it's pretty much like a benefit plan for when you retire or while you are working. So if you are a potential employee, right, most corporations or most companies, they give you the option to have part ownership of the company, right? They allow you to take that so that when you do retire at the end of the day, you have some kind of money coming in through their stocks. In this case, as a limited liability company, you do not have that option, okay? Because you're already investing your money as shareholder, right? If you're a shareholder, you're already having part of the company. So again, if you work for the company, you won't have that extra opportunity to take advantage of the stock options. Okay. All right, and then some states tax LLCs. So again, I am not in the tax division in accounting, but there are some rules and some regulations where LLCs are taxed in some certain states. So, if you are planning to open an LLC, make sure you do your research to see which states require you to be taxed for LLCs. I know for sure here in Vegas, you're taxed 100%. Because this whole entire city is a business-esque city, right? It's mostly companies that are major corporations as well as LLCs and other small businesses, right? So for sure in Nevada, you are taxed. Okay? But there are some states that do not tax LLCs. All right, and then converting from an existing business into a LLC, can it be taxed for appreciated assets? So again, if you're a small company and let's say you are a startup company, you're a sole proprietor or you're a partnership, right? You can in a couple years claim LLC status, and when you do that, you will get taxed for that. Okay. So it's like it's the same thing as applying for a better license, right? So you have that option to upgrade yourself from a partnership to LLC status. It just takes time, of course. You have to establish your company name, but another thing is you will get taxed for making that status change. Okay. Any questions in regards to LLCs?
Nope.
Okay.
No questions.
Perfect. Nope. All right, let's go over the last one, which is the fun one. I think this one's fun. A nonprofit organization. Pretty straightforward. They are not in the business to make money. So they're the ones that go against the nature of business. However, their main priority is to share or to educate the public, and how they educate is whether they choose to educate the public, whether it's a religion base, whether it's a culture base, whether it could be even educational purposes, right? Some kind of profession, right? Or they just provide some kind of public service. So what these entail here, so let's go on the right side, right? We have PETA, not us PETA, but the animal PETA, okay? And they basically are an organization that basically gives awareness about animal cruelty and whatnot, right? We got the Comic Relief that spreads awareness about AIDS. We have Susan G. Komen, which is an organization that spreads awareness about breast cancer. And then we have St. Jude's, right? They're the ones that spread awareness about children with cancer. Okay, so all these organizations, they're nonprofit because their main goal, again, is to educate the public about a certain topic. Okay, so these organizations are purely voluntarily based, as in, people who want to dedicate their time or their efforts into an organization, they would invest or become part of the organization itself. Okay? With that being said, there's of course no owner because it's all purely voluntarily based. Whoever wants to dedicate their time would choose to be part owner. Okay? So again, there is no real owner for nonprofit organizations. Okay? And their most typical type of funding would come from either the members, right? The members have to pay membership dues, right? Depending on how big the organization is, and it's purely voluntarily based, right? They're going to contribute their own money to have some kind of membership that allows them to have some kind of status, or even if they do donations or they do contributions, right? That is one way that these organizations actually raise money. They can also market their business, right, by providing, things like wristbands, right, t-shirts, right, that are selling out to the public, but they're not doing that to, make money off of it. They do that to raise money for them to be able to function the company, right? As any type of business out there, you need some kind of source of money or some kind of income for you to be able to spend the money to be able to get the supplies that you need in order to accomplish your task and your goal. So in this case, they do fundraisers, right? They work with other corporations to get either contributions, or they get donations, all right? And also, even if they collaborate with the federal or state, they also get those kind of grants as well. Okay? Yes, again, they're non-for-profit. And lastly, they get special taxes. Again, I can't tell you what those taxes are because I'm not part of taxation. And we'll talk about that in a minute when we talk about the different fields of accounting that exists, right? An accountant, there's many hats that you can wear, and you need to be able to go to school and learn every single aspect for you to be able to wear those kind of hats. So with that being said, if you would like to know more about how nonprofit organizations are taxed, you guys may do so by going to irs.gov, all right, and be able to go on that website to see all the details in regards to any taxations that involve in any business organization, all right? So this is where I'm going to go ahead and stop here. So we'll talk about business activities when we come back from the break. Okay. Let me see.